The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
All right, to misquote Gary Gnu, no news from Powell is bad news for the market. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Matt Miller. We're kicking off to the closing bell here in the U.S. The last hour of trade. Let's get a check on where the markets stand right now. We have seen drops, big drops, really. The S&P 500 down now 0.7%. Of course, it is coming off an all-time high that we hit yesterday at 66.93. I put the Russell 2000 here, the small caps. It's only down 0.3%, but at one point today we were up over 1% on the small caps. So that just illustrates the up and the down that we've seen throughout this session. Gold, another day, another record high right now, 37.61 a troy ounce. And then the U.S. 10-year yield, as Romaine mentioned, we got remarks from Jerome Powell. There are more bets on rate cuts, and the yield comes down as investors want to buy this debt, these treasuries right now, Romaine.
And when we go back to equities, if you ran the rotation function on your Bloomberg terminal earlier this morning and then ran it again right now, it will look a lot different. A rotation in some of the most defensive pockets of the market, like healthcare, like utilities, like energy. Though on a net basis, we should point out that the price action is still fairly muted in equities and across other asset classes, including bonds. That speech by Fed Chair Jay Powell, maybe it was just a bit too measured in tone to excite anyone out there.
Near-term risks to inflation are tilted to the upside, and risks to employment are tilted to the downside. A challenging situation. Two-sided risks mean that there is no risk-free path.
Powell did acknowledge the elephant in the room, though, saying that one-time increases in price levels that he sees up ahead will largely be because of higher tariffs, but that will be spread out over several quarters. And he did seem to suggest that that's going to be manageable, as did the OECD just hours earlier, which said that the consequences of tariffs are already visible in some consumer prices, but not enough to materially lower the global growth outlook. Nevertheless, the lack of any real commitment to further rate cuts took some wind out of the sails of the tech trade. We get another test of the conviction to that tech and AI trade in about 1 hour with an earnings report from memory chip maker Micron, which of course traffics in the once sleepy segment of computer storage that has recently become the epicenter of AI optimism.
Yeah, DRAM and now high bandwidth DRAM. I want to show you money market funds. This is a chart that, you know, if you step back far enough, it's always going to go up and to the right. But slope matters here. Now, it's going to continually expand as the economy expands, as corporate balance sheets expand, as a regulation changes. But you can see that we've had a drastic acceleration of people putting money into these funds since 2022. So it's risen to more than $7 billion, right now almost $7.3 billion. If we do get more rate cuts, maybe that could change things here, and investors will be looking, Romaine, for an exit from this and looking for other assets that yield more.
Yeah, I feel like I've been staring at that chart for years now. It just goes up and up. Joining us right now to kick us off to the close is Stephen Laipply, global co-head of iShares fixed income ETFs over at BlackRock. And Stephen, I don't know what actually makes that chart start to go down, because it seems like we've had several sort of catalysts where you think you would see people rotate out of that. But we haven't.
I think at this point, people are still riding that nice 4+% yield. We had a cut. Powell has sort of, thrown some interesting comments in about that, but Bowman's gone the other way and has sort of signaled, the need to be more aggressive. We'll see how that plays out. I think at some point what will happen is it will slow down. To your point, I do think that there's always going to be positive momentum in cash as the economy grows. What we're advocating, though, is let's not wait until yields fall appreciably on the front end. Now's the time to maybe start thinking about stepping out. We've been saying this for a while. But you can start, incrementally preparing for this by stepping out on the curve a bit. You can even move into something like NEAR, near, which is a 2-year duration, but still has a lot of those sectors, that some of the longer, more active products like Bink have, but just on the front end. So there are ways to do this without taking a huge amount of risk, but it's probably time to think about stepping out.
As people step out, though, I mean, you mentioned 2-year. That's not that far out. No. And you don't really see anyone really stepping out beyond 10 years into the 30-year unless you're sort of mandated to do so. What gets us there, if at all?
Well, At some point, if you do have a sharp slowdown, or at least the market starts believing that you're going to get more labor market deterioration, you could see the long end start coming down. I mean, today, just on the back of the comments, you had a little bit of a pullback in yields. If you start seeing pronounced deceleration in the labor market or concerns about that, then you could see the long end fall into more of a traditional pattern, which, I think we talk a lot about how correlations have really, the traditional stock bond correlation has gone away. It could come back if you see a sharp slowdown in the economy. So you want to at least have some insurance, stepping out a little bit further in duration on that.
I watch ETF IQ every week with Katie Greifeld, Eric Balchunas, and Scarlett Fu. And did you just eclipse $1 trillion? You've just gone over $1 trillion in AUM, right, on iShares fixed income ETFs? We have. We passed that, I think, earlier in the year. We think that market overall, so we're, $2 trillion plus globally. We think we'll be at $6 trillion as an industry globally by the end of the decade. This year, you've seen an enormous growth, and we've set a record in the U.S. I think we're like at 180 billion so far in the U.S. this year. iShares is about half of that. So the flows have been very, very strong. I imagine people want to not miss out on higher yields. There's a structural shift towards ETFs that I've been witnessing as I've watched that show over the past couple of years. But active management and fixed income is really one place where I think, active managers can really generate alpha. And I wonder where specifically you think they can best do that right now.
Well, our CIO, Rick Reeder, talks a lot about this. There are parts of the bond market that aren't really captured by a lot of the traditional indices. They play a role. We're not binary in terms of active versus index. We think both play an important role.
But active's what's hot in ETFs,
product,
right?
Yeah, absolutely, it's hot. Most of the filings that have happened over the last couple of years have been in the active space. You've seen a lot of growth in that space. A product like BINC tries to get those parts of the bond market that the traditional indices don't capture. And so I think it's a lot of stuff like the non-rated or non-agency securitized, certain parts of the credit market where you're able to clip that additional coupon. That can make a big difference. So strategies like that try to deliver those. And so if you hold a combination of these active strategies and, solid core index funds, that's a resilient portfolio.
If we were to see a material downturn in the equity market, does that end up benefiting some of those vehicles or not?
Depends on the quality tilt.
Yeah.
For the more aggressive strategies that lean a lot into high yield or lower tiers of the loan market, I mean, that might be a little bit trickier. But for strategies that are also barbelling high quality, they could benefit from that.
Well,
and of course, duration would.
Well, I asked that because you brought up the correlations earlier, and I feel like correlations, at least on a historical basis, are completely out of whack.
Yeah.
But also, I mean, you mentioned high yield. I mean, you've seen how narrow spreads are, both in high yield and even more so in the investment grade space. So in theory, if we were in for a shock, those yields would widen, or those spreads would widen, excuse me.
They're definitely grinding near the tights, right?
Yeah.
Both in IG and in high yield. And so, you could see a widening. And so that's why, if you're thinking about how to really build a portfolio against these different scenarios, you really do want to be diversified. You want to hold elements of high quality. You're going to need some degree of risk to get that incremental yield and clip those coupons, but you also want to insure yourself.
I just want to point out OH.
IO, yeah.
He's a Buckeyes fan. I just wanted to point that out.
Was that it? That was the entire comment?
I was just checking. Okay. I was just testing you, Stephen. I mean, what a fantastic team we have lined up this year.
It's it's exciting. For the record, I went to Miami of Ohio. My wife always asks me, why are you rooting? And as you know, they put a microchip in your brain if you're born in the state. You have to be a Buckeyes fan.
It's the most important team in the state,
All right. Well, as a person from Illinois, I have no idea what either one of you are talking about. Stephen Laipply, global co-head, of iShares fixed income ETFs at BlackRock, and of course a proud alumnus of Miami University in Ohio. All right, coming up, we're going to go and talk about handbags and headwinds. We had a conversation with Todd Kahn, who's the CEO of Coach Brand, to discuss the future of fashion and luxury spending. And from the future of fashion to the future of social media, Matt Miller, we're going to address what's next for the sector as the U.S. and China near a deal. I know you love TikTok, to keep TikTok ticking here in the U.S. A conversation with Jasmine Enberg over at EMarketer. And if there's anyone who knows how to invest in the future, it's longtime venture capitalist Tim Draper, from space to Bitcoin to blockchain. Stick around. A lot more coming up here on The Close. This is Bloomberg.
Under my leadership, energy costs are down, Gasoline prices are down. Grocery prices are down. Mortgage rates are down. And inflation has been defeated. The only thing that's up is the stock market, which just hit a record high.
This President Trump saying the United States is in its golden age in his speech at the United Nations General Assembly. Melania didn't look too pleased, citing the stock market rally, falling gas prices and mortgage rates, and several of his latest trade deals. Joining us live in studio is Michael Zezas, Global Head of Fixed Income and Public Policy Strategy at Morgan Stanley. And, you know, it's interesting, Michael, I just was wondering as I watched this speech, and I watched the entire thing, what foreign leaders must be thinking, especially those who have, their finger on the trigger of foreign direct investment. Do they really want to be more involved with the U.S. after a speech like that?
Yeah, I mean, listen, it's difficult to say. I think it's fair to say it's very unorthodox in what the U.S. typically brings to the table in some of these forums. We've talked a lot about what was the old Washington consensus, where the U.S. was very kind of pro-free trade and the government doesn't interfere in private industry. And now we've had, and I would argue that there's a bipartisan thread to this, a couple of sequential administrations where tariffs higher, non-tariff barriers higher, the government involving itself in the private sector more, whether it be the CHIPS Act or taking direct stakes in companies, that's kind of become more of the norm. So whether it be foreign direct investment or U.S. multinationals themselves trying to decide what to strategically do from here, kind of a reversion back to the old is not what we'd expect. And I think this very much underscores that. So any corporate decision maker here now has to think about their capital plans and how they buy capital and market access in a world where you're going to be operating in a more multipolar world, and there'll be more cross-border barriers. The old kind of free trade consensus, go anywhere to find your lower cost alternatives, no longer part of the game plan.
We were talking with Lauren Goodwin this morning, New York Life, and she said she thinks the Fed still is independent, even though the president has really weighed on some of those members, tried to fire one, installed his head of the CEA. Do you think that's the case, and will it remain independent? Does the Fed have credibility?
Yeah, I mean, I think the way to think about this is that clearly the president has openly stated he's trying to influence the outcomes of the Fed and monetary policy decision making, and he's talked about what monetary policy decisions he wants to have, and he would like to appoint more people that are like-minded with him onto the board. He hasn't achieved that yet. Perhaps next year, once Powell has moved on, maybe he'll get more of a balance in that direction. But until then, it's not like we're getting a situation where the White House.
He's got Myron, right? He's got Bowman. He's got Waller. Yeah. And if he gets Lisa Cook out.
It's clearly pushing more in that direction. So I think what investors have to take away from it is, okay, if we've got a Fed, which is already kind of tilted towards, in the dual mandate, we're more concerned about growth and inflation, then we're going to tolerate the situation with higher risks to inflation than we have before. And if you're a fixed income investor, you have to keep thinking about steeper yield curve as a consequence of this. And while that is a very consensus view, I think it's fair to say there's potentially a lot more room to run to go there.
There are broader questions, though. I mean, and this kind of goes back to the speech today about what America is in terms of from outsiders looking in on it. And it's not, of course, just what his geopolitics are, but we talk about the Supreme Court case that might allow him to remove the FTC commissioner, which could be a pretext for him to take over the Fed as well. And if we do get to that stage here, what does the pitch, what is America's pitch to the world after that as an investable place?
I mean, listen, if you end up in a truly a situation where there's sort of, monetary policy independence is truly gone, then the trends that we think are in place right now around steeper yield curve, weaker dollar, obviously those get meaningfully accelerated. That's not the reality of what we think we're looking at here. So effectively, and I'm not saying this is the right pitch, but effectively the pitch from the administration is if foreign companies want access to our markets, and if U.S. multinationals want to continue to do business in our markets, they're going to pay higher costs through tariffs for what they're importing, and/or they're going to reinvest in domestic manufacturing to make that happen. Is that going to work? That's a really important question, I think, for 2026 and beyond, because right now, all we're doing is trying to calculate what is the actual pressure that's been created on the economy by the cost side of that kind of carrot and stick, the cost side being the higher tariffs amongst other effective taxes on the U.S. economy right now.
And this will obviously be a much longer term story, and probably we won't know the answer to it to probably long after his term. But there are some other issues as well. I mean, you know, the dysfunction in Congress. I mean, we have potentially another government shutdown looming. I can't remember the last time we even passed a budget on time in this country. I think maybe, hopefully my grandchildren will one day be able to see that. But does the market care about that as much? I mean, I feel like we go through this exercise every year. The market shrugs it off. They finally come to an agreement, and then we kick the can down the road for another 9 months or so.
I think with government shutdowns, there is some element of investors and markets have kind of become immune to this, right? And it's because what typically happens is if you get a government shutdown, by the way, I think we should take the risk of this government shutdown pretty seriously, but what it would practically mean is on average, you're losing something like 0.1% off of GDP every week you're shut down. But then on the back end of the shutdown, if you're just kind of doing the back pay thing, then the money, you're just creating kind of a time mismatch in the economy, and it gets paid back anyway. So it doesn't do much to actually change the trend.
Do you see any room for compromise? I mean, Trump was supposed to meet with Democratic leaders today, and then he came out with the Truth Social post basically scuttling that. I mean, is there some potential for compromise?
Yeah, I mean, there is. I think it's hard to predict what the exact contours are because the problem is, of course, the longer government shutdowns go, the more political pain it is for one side or another. They look for the kind of narrative that patches it back together where everyone's face saving. And so I think you ultimately end up, if you have a government shutdown, it won't be long enough to really change the trend of what's going on in the economy. And I think markets have learned over time from this, and so they're likely to look through.
All right, Michael Zezas, Global Head of Fixed Income and Public Policy Strategy over at Morgan Stanley, as we continue to march toward the closing bells here on this Tuesday afternoon. When we come back, we're going to take a closer look at the AI trade and take a closer look at CoreWeave. A couple of upgrades for the stock today. The stock, though, nevertheless is down. That conversation when we come back after the break. This is Bloomberg. Time now for our top calls. Big movers on the back of analyst recommendations. And we start off with Antero Resources. Citi raising the stock to buy, boosting the price target to 39. Analysts saying that the natural gas producer can benefit from its pricing power and well productivity. Those shares up 3% on the day. Next up, Lululemon. Baird slashing its rating on the stock to neutral from outperform and cutting the price target down to 195 from 225. Demand pressures is what the analyst says here in the U.S. and Canada as the key concern. Nevertheless, the share is getting a modest bid on the day, up 0.5%. And finally, NVIDIA, CFRA doubling down on its bullish call, upping its rating to strong buy, raising the price target to 225. The analyst saying the OpenAI partnership and a possible re-entry into the Chinese market could drive notable upside in the next 3 to 5 years. Those shares, though, taking a breather from its breathless rally this year, down about 3%. And those are some of our top calls. We do want to stay in the AI space and take a look at the hyperscalers. CoreWeave getting a couple upgrades today, including from over at Wells Fargo. Analyst Michael Turrin taking the stock to overweight, setting a $170 price target. Michael Turrin joins us right now, Managing Director and Software Equity Research Analyst over at Wells Fargo. All right, let's talk about this spend here. I mean, let's forget the fact the shares are down today. They've had a phenomenal run, Michael. And I am curious about what keeps that going. What gives you the confidence that we're going to continue to see this pace?
Yeah, I mean, we think we're still early innings in terms of where the AI demand cycle is going. Our upgrade of CoreWeave is predicated on a view that the technology here is clearly differentiated. And we're still in the earlier stages of the market forming. We're seeing numbers that we haven't seen often before. Nebby has signed a $20 billion contract with Microsoft. Everyone saw Oracle's multiple $100s of bookings show up a few weeks ago. We think CoreWeave actually has a leadership in terms of tech differentiation here and expect we'll see continued improvement and expansion of their own underlying customer momentum. Recall, OpenAI became a $16 billion customer here not too long ago. Microsoft is a substantial customer. And we still think it's early days in terms of the innovation cycle and where this is all heading.
Well, I am curious about a couple of things. One particularly on valuation. I mean, we are still talking, even at a $170 price target, that still puts it below its all-time high or its recent high that it hit, I think, back in June of this year. And it raises a lot of questions, not so much about the growth in the industry, but whether the valuations on some of these stocks are commensurate with that growth.
Yeah, it's pretty interesting set of circumstances here, I have to say. This is a company that is growing greater than 100%, not a growth rate we often see in software. The stock has ebbed and flowed because I think they're defining a new market, and investors are having a harder time handicapping that because of all the general puts and takes. But the stock, from our vantage point, is trading at 22 times our price target. Not even where the stock is currently trading. Our $170 price target is predicated on 22 times our 2027 EBIT estimates. That doesn't feel overly demanding, given that's where some of the mature hyperscalers are trading at smaller growth levels at this point. So, even though there's a lot of elevated conversation around, the AI trade, the AI market forming, still seems to us that CoreWeave has room for meaningful estimate revisions if they're able to deliver on increasing some of these customer relationships, and room for multiple expansion, given multiples look relatively reasonable for a company we think is a tech leader here.
You mentioned Microsoft is a substantial customer, Michael. Is it right that they provide 71% of CoreWeave's revenue? I mean, are they really taking that much or giving that much revenue? And does CoreWeave really need to diversify away from them?
Yeah, so OpenAI is not a material revenue contributing customer yet. So that gets to a little bit more diversification, but certainly not as much as we're used to seeing in tech markets. Even CoreWeave will acknowledge this market is likely concentrated for the foreseeable future. It's hard to find customers that can book tens of $billions of contracted bookings for a company like this. The market's still forming, so it's primarily the hyperscalers who are participating. We think over time, this leads to a longer tail of use cases across broader enterprise, which CoreWeave will prove able to tap into eventually as well. But right now, the build cycle is on, and it's primarily predicated by the hyperscalers. So you're seeing some soft diversification in that Microsoft has grown into an OpenAI relationship. CoreWeave talked on their last earnings call around striking a relationship with Google. So they are showing up in the preferred customers you would like them to. But that's likely the case, that the next couple of years of growth are predicated from these large spenders first. And then as the technology continues to move and ideally the cost to serve the technology comes down, that's where you could see broader enterprise spend and CoreWeave tap into a broader market.
Right. So the build out still happening, and that costs a lot, and hopefully the revenue will come. Thanks, Michael Turrin there, Managing Director and Software Equity Research Analyst over at Wells Fargo. Coming up, we're going to talk about handbags, aspirational luxury. Coach's big bet on Gen Z is paying off. Romaine sit down with the brand CEO about the next chapter for the decades-old retailer. When we return, this is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to The Close. I'm Romaine Bostick.
And I'm Matt Miller. We are looking at an equity market that is selling off. And I guess the real turn happened after Jerome Powell gave his speech. Just not enough clues in there that we're looking at more or steeper rate cuts.
Can I tell you, I kind of scratched my head, not what he said, but the market reaction to it. Were people expecting him to come out today and be like, prepare for the next 6 rate cuts?
I don't know. Like when I saw the headlines and we get a look at what he's going to say with the speech before, I thought it seemed relatively dovish. It indicates to me that you're going to get continued cuts at each of the next meetings. Yeah. But when you look at the market reaction, it's like we got to buy these bonds now and sell off the stock. So.
And just to be clear, I mean, he still made it clear that the Fed still has a big focus on potential weakness in the labor market, which would indeed be dovish. But basically he said, look, we're hedging our bets. We're still concerned about inflation. But he said, look, he thinks that at least the impact from tariffs is going to be more of a one-off. It'll be spread out over a few quarters, but it will be sort of a one-time price level increase, which he thinks, in his words, are manageable.
I think the bond market is reading it a little bit differently than the stock market. We used to say that, the bond market was the smart money. Yeah. And you see that the 10-year is down almost 4 basis points. Yeah. And, the stock market turned around. The Russell 2000, I said at the top, was up more than 1% and then dropped into negative territory. Yeah. So.
Yeah, well, the NASDAQ down about 1% on the day here. The S&P down about 0.7%. One of the bright spots out there, Matt, it's actually Tapestry. Not only up today, it's up 77% year to date, which is on pace for its best annual gain in more than 20 years. In fact, it's trading at a record high. This coming as Gen Z shoppers are helping to revamp the 84-year-old brand. The CEO of its parent company, Tapestry, told us earlier this month that the company is now going to try to apply the Coach playbook to Kate Spade as part of an overall strategy to boost growth. Now, I had a chance to sit down with the CEO of the Coach brand. His name is Todd Kahn. He's responsible for a lot of the Coach bags and Coach shoes that you've seen on the streets of America over the last few months and years. Here's what he had to say.
We have noticed that Gen Z are spending a little bit more. They're also coming in more frequently. So I'll give you one quick example. We have beautiful bags. We also do this great job with bag charms. So often that second purchase might be a bag charm, or we recently launched 2 incredibly powerful sneakers, a Soho and a Highline, and we're getting a lot of traction, all pun intended, on both those sneakers. So,
well, talk about those bag charms. I mean, so when someone comes in to buy the bag or they buy it online, are they buying the bag charms at the same time, or is the idea that you get them with the bag and then a couple weeks later they decide I need some accoutrement to put on it?
Yeah, it's super interesting because I keep seeing the success of bag charms, but our UPT didn't materially change, our units per transaction. And so when I talk to our store people, because that's where you gain so much insight, what they said is the Gen Z customer has this bag and she knows what bag she wants. She might have been coveting it for some period of time. She buys the bag, she sees the charm. That's a second trip. And we love being able to interact with her in our stores. We're 90% direct to consumer, and getting that second bite at the apple, even though the cherry charm is probably our #1 charm.
How much pricing power do you have? Do you ever sort of look at some of the popularity of some of your items and think, we can sell this for maybe $300 more than what we're currently selling it for?
We're very, very cautious about that. Again, I don't want us to be off-putting. One of the things we know is there will be 25 million women who turn 18 this year and for the next 10 years. In the markets we are already transacting. So this isn't going into different markets where they're not. I want to be their first bag. I want them to come to Coach and want us and stay with us for a long period of time. And it's not just maximizing what short-term price. We're building something really sustainable for a long period of time.
How do you protect those margins, particularly at a time when tariffs are higher, significantly higher than where they were a year ago? And even in the absence of tariffs, there are a lot of input costs, I would think, that are also significantly higher for you than what they would have been just a few years ago, too.
Yeah. Well, one thing is we have a manufacturing mindset. So we started as manufacturers. We never gave up that DNA. Our relationships with our service providers go back 20, 30 years. At one period of time, I oversaw all of our sourcing. So I know these people really well. So there's a partnership that we have together with them. You can't put all the costs on them. It's a partnership. We have taken price over time, but very systemically over the last 5 years. Sometimes it's about changing your assortment. The biggest issue you have in a fashion business is over inventory or over assortment. When you talk about fewer ideas that are richer, you reduce your markdown liability. So if you reduce your markdown liability, you actually don't have to just take top price. You take an overall higher gross margin over time. So finding that right blend is really important. You're seeing us deliver that with the increase over the last 5 years of our gross margin.
In the past, discounting was a big strategy of Coach. Is it still?
It's far less. We love value change. We think our bags at the $200 to $500 price point have incredible value. We don't have to scream discounting on top of that. When you see a Tabby bag, when you see a Brooklyn bag, $395, the richness of the leather, you see the value in it. You don't have to say, oh, and now buy it for 20% off. That message diminishes your value as a brand. If the worst thing a brand can do is have the perception that you're always on sale, it diminishes desirability. And so we focus on fewer ideas, richer stories. That's why we have fashion shows. That's part of what fashion considers R&D. They see that it creates a desirability for your brand and your product.
It's late September, so you have to be thinking about the holiday season, right? I mean, what does Coach look like this holiday season? Do you sort of go into a Black Friday with a discount mindset in order to sort of compete with all the other folks that are going to be putting their products on sale?
The answer is generally no. So we'll have maybe a doorbuster idea in some channels. They're very smaller ideas than historically. What we want to talk about is this is the holiday, and I think if the consumer is more choiceful, as we've seen, they want the best bag. They want the Tabby bag. They want the Brooklyn bag. Tabby, a desirable bag at $395 or $495, because the brand is so compelling right now, is a lot more compelling gift to see under the tree than something somebody bought for 40% off for a lesser concept.
And just real quickly, I mean, you've been talking a lot about bags, and obviously that is the hallmark of Coach. But if you walk into a Coach store or go on the website, you see shoes, you see jackets, you see sunglasses, you see a lot of other products out there. Selling fashion that maybe isn't sort of in the bag space, is that harder to do for something like a shoe or sunglasses or a jacket as relative to a handbag?
Well, from a business perspective, we love handbags. You don't have seasonality, you don't have the size issues that you have. That is our core product, and we can win and meet all of our investors' expectations for the next 3 and 5 years, winning in that category. That said, we are an 80-year-old brand. We have a creative director. We have fashion shows. We have the credibility to win in some of those other categories. Our next most important category is footwear, specifically sneakers. We know Gen Z, 50% of their closet is sneakers. So if you want to win with Gen Z, you have to win with sneakers. So we're doing that. You'll see us expand slowly and carefully into ideas that we've talked about for a long time. We're the house of leather. So I think our leather jackets are the best in the world, period, bar none. So you'll see us continue to do that, but we always stay very focused on our core category.
And that was part of my conversation that I had earlier today with Todd Kahn, the Coach brand CEO and fellow Chicagoan. When we come back after the break, we're going to talk about Boeing. The stock moving, so too is Palantir. We're going to explain why when we come back. It's part of our Stock of the Hour right here on The Close on Bloomberg.
Shares of Palantir and Boeing are taking off on news that the two are teaming up to integrate AI systems and software across Boeing's factories and programs. Here to discuss the sector and really the stocks is Bloomberg's Norah Mulinda. So Norah, this is, I mean, in a way, this is your beat, right?
100%.
You cover defense, you cover aerospace, and this is, I think, a fascinating partnership that was announced just minutes ago.
Definitely a spectacular development here that we're seeing. I mean, Palantir has just been getting really massive deals. If you're looking at the stock, it's up more than 2,000% over the past 5 years. So that just tells you a bit about the enthusiasm behind AI and just also the deals that they've been making, up to $10 billion deal that they made with the U.S. Army. So this is also another deal here. Of course, that'll be great for Boeing here, especially as we look at the company that was pressured last year, down more than 30%, now up about 22% year to date when we look at shares of Boeing. But when you really look at this partnership, it really just shows about how people are really trying to integrate AI into every sector that we're looking at. Demand is high, and you're really seeing them coming and making the mark here.
I mean, one of the knocks on Palantir, particularly when they became public, was the idea that they were so dependent on government contracts. And I know they've tried to broaden that out with more industry contracts, and I guess Boeing falls into that category.
Most definitely. And if you think about just defense more broadly, I mean, I look at the S15 Aero. That's the index that I always look at when it comes to aerospace and defense. And we are seeing that index up about 37% so far this year. Most of that is driven in particular by those aerospace companies. So when you think about diversification, that's what Palantir really wants to do as we think about partnerships with other companies, and Boeing, of course, being a beneficiary here today.
Yeah, I mean, I think that's the key, right? Boeing should be the beneficiary because they need help. If you look at their stock performance over the past 5 years, it's up 32.8%, which is better than a stick in the eye. But Air France has tripled in that time.
Right.
So, obviously these are the only two major plane makers on Earth, and the European one is doing a hell of a lot better than the U.S. one. So hopefully they can use this data and improve their business.
Right. I mean, it definitely is a battle between our U.S. home-based defense contractors. We're seeing a lot of Wall Street really starting to rally behind some of the European defense contractors. Of course, we knew earlier in the year there was really just this bet on Europe really trying to invest in their own homegrown defense. And so you were seeing a lot of the street starting to run over to investments in Europe. But I mean, it's not like, it's definitely important to mention that we do still see some great progress here at home. And we are seeing contractors definitely benefiting off of this. Boeing, 35% of their business is purely defense. So definitely something to keep an eye on.
Yeah, absolutely. We're going to talk about more about the progress that we're making here, right? We had, 28 record highs so far this year.
Yeah, on the S&P 500.
Yeah, the S&P.
That's pretty good, right?
The S&P's up 13%.
Yeah.
That's pretty good.
That's pretty good.
But not as good as the Germans.
I knew where you were going.
They're up 20%, right?
That's where you're
The
taking
Spanish are up 30%. Norah, Mulinda, thanks very much.
Yeah,
We come back, we'll take you to the closing bell with Kevin Mahn, President and Chief Investment Officer at Hennion and Walsh.
I do think that there's always going to be positive momentum in cash as the economy grows. What we're advocating, though, is let's not wait until yields fall appreciably on the front end. Now's the time to maybe start thinking about stepping out.
Stephen Laipply, global co-head of iShares fixed income ETFs over at BlackRock. A closer look at the bond market. Yields down for the first time in several days. I don't know if that was because Powell spoke, or maybe it was more concerns here about economic conditions.
Yeah, it seemed to me that the bond market was reading Powell's speech a little bit differently than the equity market.
I thought so too.
The bond market seems to say, all right, he's going to cut at the next meeting and the following meeting, so at least two more cuts here. And as a result, you want to go ahead and buy the treasuries that are out there now because the rates are going to be lower in the future. The stock market, on the other hand, really turned down. I mean, when I was anchoring Bloomberg's open interest this morning, as I do every weekday from 9 a.m. to 11 a.m., we saw an uptick in the S&P. It wasn't huge, but green arrows. We saw Russell 2000 that was positive, and it was up by 1%. And now both of those have turned down pretty solidly. So, yeah, I think two different interpretations of Powell's speech.
Yeah, a bit of a risk-off tone here on this day with people piling into treasuries, selling the dollar just a bit here. And, of course, crypto still remains in the red. We should also point out, too, we had that OECD commentary earlier this morning here about economic conditions into 2026, which also is fueling some of the rate cut debate. Kevin Mahn joins us right now, President and Chief Investment Officer over at Hennion and Walsh Asset Management. And, Kevin, I do want to start there here about economic conditions, at least in the context of what it means for the markets. No one's really saying we're falling off a cliff, economically.
No, certainly not.
But there is weakness out there. And I do wonder how you price that, at least on the equity side, how you price that in.
Well, let's look to the Federal Reserve, right? If you look back to June, they lowered their forecast for real GDP growth to 1.4%. That shocked me, at least. And at that same time, they raised their forecast for unemployment to 4.5%. This time around in September, they raised the GDP growth estimate slightly to 1.6%, but well below what the Atlanta GDP now reading for third quarter is shown of 3.3%. So who's going to be right? Is the economy going to slow to that point in time? And if it is, perhaps that's why the Fed is now forecasting 2 additional rate cuts of 25 basis points each over the balance of this year.
We're still talking about equity market despite some of the losses today. They're still sitting on pretty healthy gains year to date. And, of course, if you segment it out into the tech sector, phenomenal gains.
Sure.
What's keeping that afloat? Is that all just the AI trade right now?
I think it's more than just AI. I think you just need to follow the money, Romaine. And where is the money being spent right now? In 2 places, AI infrastructure and aerospace and defense. We learned that NVIDIA is investing $100 billion into OpenAI. We're getting numb to the size and sheer magnitude of all this spending. But what it reminds me is 2 things. The money is being spent in AI infrastructure, and the opportunities exist not just with NVIDIA, but beyond NVIDIA. And 88% of NVIDIA's revenue last quarter didn't come from chips. It came from data center revenue. So where can you find those other opportunities? I think they exist.
So where?
So let's look at a couple of areas. Let's start with IES Holdings. It's a company that provides the electrical networking for data centers. How about a company like Comfort Systems, ticker symbol FIX? They provide the cooling solutions to data centers. Those two stocks are up nearly 89% year to date. Hey, NVIDIA is up over 30%, not bad, but there are other opportunities in the AI ecosystem as well if you look beyond the chips into the critical AI infrastructure areas.
By the way, do you think, if you step back and look at the broader market,
yes,
do you think we continue on this path if we do get GDP growth? You know, the path up is what I mean, up and to the right. If we do get GDP growth that's between 1% and 2%, because it seems that equity markets historically do worse in that sort of soft spot than they do if GDP growth is bad, below 1%,
sure,
or great, above 2%.
Sure. I mean, we've had 25 record closes coming into this week for the S&P 500.
28.
That was for the NASDAQ, though. I believe it was 25 for the S&P 500. You could be right, Matt.
We'll do a little research. We'll do a little digging there.
On top of 57 such record closes last year. So investors would be right to question, when is this rally going to end and when is volatility going to return? However, Goldman Sachs put out a study that looked at the last 40 years and saw that when the Federal Reserve cut interest rates after a 6-month or more pause, on average, in 4 of those 8 instances, the S&P 500 rose by an average of 8% over 6 months and 15% over 12 months. Perhaps that's another tailwind for these markets, provided that the economy doesn't slow to the extent where we're worrying about a recession. And that's not my base case right now.
All right, I do want to go back to some of the individual stocks, because we are going to get Micron earnings tonight. And I've been kind of surprised at some of the strength we've been seeing in the memory and storage companies.
Sure.
You know, Seagate, Micron, Western Digital.
Yep.
I mean, I understand it conceptually. You know, obviously, when you talk about the AI trade, you need memory, you need storage.
Yep.
You mentioned Comfort Systems and a few others. This idea of a broadening out of this trade, so it's not just about the super chips that NVIDIA makes or the, you know, the hyperscalers or whatever. How much further does it go? Do we start looking at financial institutions and productivity gains from AI, or consumer companies and how they incorporate it as well?
Sure. And Romain, if I could use a baseball analogy, I would suggest that we're in batting practice right now.
Batting practice. Wow.
In terms of the AI revolution.
Okay.
The AI infrastructure build-out is batting practice. Over the course of the 2 games, we're going to see real-life deployment of AI strategies that will transform the economy and society. But you talk about chip makers. Do we know that NVIDIA doesn't make their own chips? Taiwan Semiconductor does. Interesting. The largest dedicated chip foundry in the world with a 60% market share. But they don't even do their own lithography. ASML does. And both of those companies ride the coattails of NVIDIA. And they all need power. We need to lean into that power trade.
On that point, though, as an investor, if you are investing in those names, how comfortable are you investing in non-U.S. names or companies that have a lot of cross-border exposure, given the geopolitics specifically around these advanced chips and technology?
And I'll use Taiwan Semiconductor as an example there. So I happened to have the opportunity 2 months ago to visit the plant that they built out in Phoenix, Arizona. It is massive in sheer size and scope. And we know that NVIDIA is now looking to onshore the development of their chips in the U.S., but using Taiwan Semiconductor because of that new facility that they bought in Phoenix, Arizona. So is it a concern? It certainly is a concern. But NVIDIA has been able to navigate that pretty well right now, and I think companies like Taiwan Semiconductor are doing it as well. But you need to take that into consideration and not pay too much for these stocks.
I thought it's funny that they're building in Phoenix. I thought they had to keep those chip centers cool.
Yeah.
I mean, that seems like the last
Phoenix,
place.
Arizona, in the middle of nowhere.
Yeah, I once spent an interesting summer in Phoenix, Arizona. I don't recommend it.
Maybe it's solar powered.
Sure, you still got to cool it, though.
And where's the water?
Yeah, no. That's a good point. We should dig a little deeper into that as well.
Yeah.
All right, Kevin, got to leave it there. Kevin Mahn is President and Chief Investment Officer at Hennion and Walsh Asset Management. As we count you down to the close, and just a reminder, we are expecting earnings, Matt Miller, out of Micron just after the bell tonight. Maybe another read here on just the sustainability of the AI trade.
Yeah, we'll get more on how much of that DRAM they're selling, or high bandwidth DRAM is what Ed Ludlow tells me.
Yeah.
It's all about these days, because you need, obviously, an absolute ton of memory. You need power, you need water, and you need memory to make these things work, as well as, obviously, the GPUs and the server racks.
Yeah, absolutely here. So on this Tuesday afternoon, we are looking at stocks in the red, but kind of a flip-flop from what we saw yesterday, where the majority of the stocks were in the red, but the markets were in the green. Now, the flip-flop of that today, the majority of S&P stocks in the green, yet the index right now in the red, a big drag down, but some of the big names, a full breakdown when we come back. This is Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic here with Matt Miller, taking you through to that closing bell with a global simulcast. Carol Massar and Tim Stenovic join us from the radio booth. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. Right across the screen, Carol Massar, though, that was a bit of a change from what we saw just a few hours ago.
Yeah, not a new record, right? We've talked about, we certainly heard from Fed Chair Jay Powell kind of talking about maybe he was also asked about the markets and so on and so forth. I think the real read is that he didn't necessarily commit to, more rate cuts. And I think the expectation.
Were you expecting him to do that?
I did not. Okay. I believe he's data dependent. If there's any message, T-shirt or hat that I bought from Jay Powell, that's the one, data dependent. And so.
Will that be the title of his book?
No.
Data Dependent, the Jerome Powell story.
He does have a new book out, though.
He does?
No, he doesn't have a new book, but he was talking about a book.
Oh, he was talking about a book.
Yeah. Shouldn't he? Okay, never mind.
Okay.
Was it Infinite Jest?
Oh. David Foster Wallace, a classic that I'm sure Matt has on his shelf. Hey, there was a moment, though, at about just before 1
one
p.m.,
of those books that everybody has on their shelf, but nobody's actually read.
I didn't mention that part.
It's like that and the Power.
Wait, one of our producers, Talia, says Powell's book, Painful and Transitory.
That could be the name. That's good.
Well done.
12:58 p.m., if we talk about crucial moments of the day, it is when Jay Powell said that some asset prices elevated versus historical levels, and by many measures, equity prices are fairly highly valued. We did see stocks move lower after those comments, but he did say it's not a time of elevated financial stability risks.
Okay, I have no idea what any of that means, but we have right across the screen here on this Tuesday afternoon as we get the closing bells in New York. The Dow down about 80 points roughly, or about 0.2%. Takes a while for these numbers to settle, but you see the damage there on your screen. The S&P down more than 30 points, or 0.6%. The NASDAQ composite down almost 1% on the day. The NASDAQ 100 down 0.7%, and the Russell 2000 closing down 0.2%. I just want to point out, though, that Dow Transports and the S&P Equal Weighted Index are both finishing out the day in the green.
All right, good to know. Let's go back to the S&P 500. So the large caps, 278 names to the upside, guys, 222 to the downside, and Matt, 3 unchanged.
Yeah, let's take a look at what the breakdown looks like in terms of industry groups. We had most of them in the red today. You can see that energy was a gainer as the underlying asset was rising. Oil is up more than 1% this morning, or this afternoon, I should say. Consumer staples, industrials, and healthcare rising there. But everything else in the red, including the all-powerful and heavy IT and communication services. That's where those hyperscalers hide out. So you need them to gain in order to have any decent traction on the S&P 500. Although I should say we're not that far off of the record close yesterday. What was it, 66.93, I think?
Yeah, just going to interrupt you here. Micron earnings are crossing the wire right now. The maker of that high-end memory and storage chips here for its fiscal fourth quarter, the company says EPS did actually come in above estimates, $3.03 a share. The street on average was looking for $2.84 a share. On the revenue side, $11.32 billion in revenue, a slight beat over analyst estimates. On average, they were looking for about $11.15 billion. Gross margin also did expand to about 45.7% there. You're seeing a modest increase in the shares here in the after-hours session. I'm going to dig a little bit deeper and try to find some guidance.
Shares up about 1.6% in the after hours. In the press release, Sanjay Mehrotra, the company's chairman, president, and CEO, said that the company's uniquely positioned to capitalize on the AI opportunity ahead. He actually calls out being the only U.S.-based memory manufacturer. He said it's a record-breaking fiscal year, exceptional fourth quarter performance that underscores our leadership in tech, products, and operational execution.
All right, sounds like the data center business, right? Really some outperformance there. He says in the press release, keep in mind that Micron has been on a tear this year.
Yeah, let's get you the forecast here. The company is saying now that for its fiscal first quarter, it is guiding revenue in a range of $12.2 to $12.8 billion. The low end of that range is above the average of analyst estimates of 11.91. Adjusted EPS being guided in a range of $3.60 to $3.90. The low end of that range above the average of street estimates of $3.05, and gross margin for the current quarter, the company guiding 50.5 to 52.5%. The low end of that range above the average of analyst estimates of 45.7.
Yeah, I think that's so interesting when you look at not only are they going to grow more than the street had forecast, they're going to see bigger margins, right? So they're making more money. It's not like they're buying this growth. We talk so much about we've been talking so much today and yesterday since about noon after that NVIDIA announcement about the kind of circular nature of this AI infrastructure, right? OpenAI wants to buy GPUs from NVIDIA. NVIDIA invests $100 billion in OpenAI, and then they can afford to pay that revenue. Well, it looks like Micron isn't in that position. They're raising the revenue. They're raising the profit as well, with earnings per share also eclipsing what the street was looking for. So a beat on pretty much every level.
All right, so Micron continuing to trade up about 4% here in the aftermarket. I'm going to go back to some of the individual gainers in the regular session. I think I mentioned Paramount Skydance, an outperformer up at its highs, up 12%, finishing the day with a gain of about 6%. Remember, Paramount Skydance is said to be preparing a bid for Warner Brothers Discovery. I didn't see any real new news.
Yeah, why is it up?
I was
watching this all day and I couldn't figure it out.
I have no idea. At one point, it was the top gainer in the S&P 500. So I have no idea. On Friday, we did see CNBC talking about an offer that could land in the range of 22 to 24 per share. Although he did caution that, or the network cautioning that the price range was speculative. An offer could come later than previously expected. So Paramount on a tear. Warner Brothers.
Because of TikTok.
Was down a hair. Why?
It's because of TikTok, right?
Is it?
That's just my guess. I mean, considering Oracle rose on TikTok yesterday, and it's like father like son. Is that not the case?
I don't know. Matt says, but TBD.
This is Larry Ellison's kid, right?
Yes, it is.
Yes.
So as we all start to consume all of our media across short messaging apps like TikTok or short video apps like Vine, maybe Paramount Skydance somehow gets in on Vine.
But I would almost say like if it was maybe Fox or something, right? Because isn't Murdoch now said to be maybe a part of it? So.
Yeah. Well, Donald Trump said Lachlan was going to be involved as well as Rupert.
All right, I'm moving along to Kenvue because this one bouncing up 7% at its highs today, finishing the day with a gain of about 1.5%.
Kenvue, acetaminophen.
Yeah. Nicely said.
Thank you.
Well done. President Trump's call. Yeah. I mean, listen, there was a rethink. There was a lot of doctors. We actually had a great doctor on our air talking about still planning to give it to his patients.
Yeah, Dr. Todd Ivey from the American College of Obstetricians.
And really going by the science and the research that's been out there. He said Tylenol, I mean, this is acetaminophen has been researched to death and has been around for a long time. So keep in mind.
All the way to death.
That's a weird choice of words, but okay.
Yeah.
Keep going, Carol.
God, boy, I'm missing Katie.
Is Matt in all week?
He is.
I'll be here all week.
Curious.
It's like having my four brothers around. Sorry, I forgot.
One of them doesn't matter
who's
as
that extra
much.
brother that you forgot?
All right, for something different, I'm going to mention SoundHound, up as much as 11% at its highs today, finishing with a gain of about 4.25%. Company and seafood restaurant chain Red Lobster announced a partnership to roll out an AI-powered phone ordering agent.
I love this.
I know.
Because I have no idea what it means. So
I don't have any idea either. I don't know what that is.
phone ordering agent? So what, I can just get my lobster on what? Like the AI orders it for me or something?
I don't know. But the shares are up about.
As you can tell, I'm a big Red Lobster fan.
Shares are up about 30% in the past 7 trading days.
I've never been in a Red Lobster.
33% of the float is short. You know?
It's like I'm not even black.
I'm not even listening to you. Sure. Anyway, it's an outperformer. Tim, over to you.
I am going to go with the Mag 7 Total Return Index. Tech taking a hit today, big tech. All 7 of the Mag 7 ended up falling today. Amazon and NVIDIA dragging down the index, down 1.54%. Actually, the worst day in more than a month for the group. The Mag 7 still collectively up around 19% so far this year. Also, keep an eye on what happened with Vertiv and other electric power equipment companies today. Vertiv down 6.2%. This after Microsoft said it developed an in-chip cooling system that can essentially cool a server running core services for a simulated Teams meeting. The announcement coming from a blog post from the tech giant. I didn't know those were so. Okay. I didn't know those were so intensive when it came to the heat that was produced.
Maybe that's why it takes so long to load on my computer.
I don't know. No comment there. We also saw shares of Eaton and some other electric power equipment companies fall on that news. And finally, Firefly Aerospace. This is the small rocket launching company that went public just a little over a month ago. Ticker FLY. It fell 15.5% today. This after the company came out with second quarter revenue that came in short of Wall Street expectations. The company did make history, though, a few months ago back in March when it landed its Blue Ghost robotic spacecraft on the surface of the moon.
Yeah.
That was in partnership with NASA.
A quick check on yields here, pretty much down across the board, and that would seem to be largely because of some of the comments that Jerome Powell laid out in that speech earlier today out there in Rhode Island. The quote, challenging situation, in his word, in balancing out the risk between inflation and the labor market. You can see that most of the activity was on the longer end of the curve here. Slightly interesting here when we talk about folks that maybe had been still piddling around that steepener trade.
All right, that is a wrap, guys. We're watching Micron shares, though, after earnings up about 2.2% here in the aftermarket. A wrap, our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals, we call it Closing Bell. We have Romain and Matt continuing there on the close, and Tim and I can continue right here on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
Our coverage continues here on Bloomberg Television. One of the biggest movers in the after-hours session is Micron, a full breakdown of the earnings that they just reported. That's coming up next here on The Close. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome to The Close. I'm Matt Miller.
And I'm Romain Bostic. A little bit of a pullback here on this Tuesday afternoon from those record highs on U.S. equities. And I say a little just to be sure. Down about 0.5% on the S&P 500. A bigger move on the NASDAQ. But again, still perched near those record highs. Take a look at spot gold, because if you are looking for a record high, you're going to find it there, up for a third straight day. That relentless move higher as a lot of people pricing out, at least for right now, the inflation risk. Meanwhile, in the opposite direction, Bitcoin down for the seventh time in the past 10 sessions, pulling back from some of those recent highs as well, Matt.
Yeah, Bitcoin leads nicely into my first mover. I'm looking at a board of individual stocks today that put up some outsized gains or losses. In Coinbase's case, a loss. And Bitcoin really been moving steadily down after hitting a high of $123,000. Still impressively strong in Coinbase as well. Halliburton right now up 7.33%. So we have defense stocks, we have aerospace stocks moving higher today. Paramount Skydance, the David Ellison vehicle that we were just talking about with Carol and Tim, up 6% today. And I had a media analyst on yesterday, Anna Berry, who said she thinks Paramount Skydance is going to somehow get in on the TikTok deal that we already know is going to involve David's father, Larry, as well as, according to the president, Lachlan, and his father, Rupert Murdoch. And then NVIDIA right now down 2.8%. NVIDIA having a tough day after that $100 billion deal with OpenAI was announced yesterday at noon, but today, the narrative seems to really be about a struggle. If they have to provide a customer with $100 billion in investment to get that kind of revenue, it begs the question of, well, Bain Capital says there's going to be an $800 billion shortfall in the build-out of AI through 2030.
Yeah, and we talk about AI a lot on this show, and that actually brings us to the top story for this afternoon, and it's really where the AI trade actually stands. A bit of an evolution, which has finally started to see some evolution from the chips sold by NVIDIA, and of course, the data centers being built out by the hyperscalers like Microsoft. The AI trade, it's now firmly swept up the once sleepy segments of the tech industry, like memory and storage companies. Seagate and Western Digital, they've more than doubled over the past 4 months and are now the second and third best performers in the S&P 500 year to date. SanDisk, that price, it's almost tripled. And then there's Micron. Founded in the basement of a dentist's office long before Mark Zuckerberg and Sam Altman were even born, Micron has now become an AI darling among investors. The stock rallying for 14 of the past 15 sessions, up 40% this month alone. That rally fueling big questions, though, as to whether these gains will be justified by future revenue and future profit growth. And well, we got a potential answer to that question just moments ago when Micron reported earnings for the most recent quarter, but gave guidance for the current quarter that did suggest that profitability and, more importantly, that revenue growth is going to continue unabated, at least in the short term. Antoine Chkaiban joins us right now, equity research analyst of technology infrastructure over at New Street Research. And Antoine, what was your first reaction when you saw the results out of Micron today?
Hi, Romain. Thanks for having me on the show. So, yeah, the key metrics we look at here are COGS, of course, and pricing, and that's driving, you see COGS growing sequentially, you see gross margins expanding, and revenues, growing more than 20% sequentially. And that's supporting very much, our perspective here, because memory is a constraint that everybody's addressing at the moment. Models are getting larger, improving the performance of AI models requires more and faster memory. And memory is the fastest growing segment of AI infrastructure. And you see that in the roadmaps across the board, NVIDIA's roadmap in particular, and that's driving a supply squeeze. Memory is very elastic. Demand going up and capacity getting tighter is driving prices up, and that's what we're monitoring in today's results.
In terms of the growth, sequential, double-digit sequential revenue growth, margins over 50% gross margins, we should see an operating margin of more than 40% if they execute. Do you have faith that they can?
Yes, I have a lot of faith that they can keep executing. Now, the question is how much more upside is there? We see, a little bit of upside to expectations for the coming quarters and the coming years. But, at this point, the surprise is getting thinner and thinner, And if you add to that the fact that valuation, has already, improved a lot, it leaves limited room for further re-rating. After the rally, you see Micron trading, at an elevated multiple relative to history. And, the only significant catalyst that we see now is if gross margins return towards maybe 60%, and that's the kind of peak that we've seen in 2017, 2018, and we don't really have clear visibility on that yet. So I'd start to become a bit cautious at that point.
Well, I am curious just about this idea that traditionally investors always kind of viewed Micron as being kind of one of those cyclical names in the chip sector. And if we are, at least just hypothetically, maybe potentially breaking free of that, Antoine, do we need to sort of rethink the valuation, or is it too soon to do that?
Yeah, that's a good point. I think when you look at Micron, you need to think about it as how memory content is growing on one end, and on the other end, how the main memory vendors, and you have 3 main memory vendors out there, are adding capacity. And you need to look at one in conjunction with the other. And at this point, the 3 vendors have been very, very rational in the way they've been adding capacity. And so if you think about it that way, the stocks could become a bit less cyclical. Huh? But even if you look at it that way, we're already at a peak in terms of, where the stock trades, in terms of peak earnings. And from that standpoint, as long as we don't have visibility whether pricing is going to recover even further and we'll get to the kind of gross margins that we've been to at peak levels in the past, I don't know, whether we want to make that call yet.
I'm just looking at a story that we're going to be talking about, Lithium America's shares. The U.S. is looking at a 10% equity stake, according to Reuters. And it's unrelated, obviously, to Micron and to DRAM, except for the fact that it's a commodity. Now, it's a hot one, and DRAM is a hot commodity right now. But as Romain just pointed out, there are times when it's not. It's a cyclical business. Could you imagine the U.S. ever taking a stake in a company like this, or a company that makes this kind of commoditized memory chip?
I mean, when you think about it, the way I would address that question is say, why is memory cyclical? Memory has been very cyclical just because in the past you've had very, very significant peaks and troughs, when you compare demand relative to supply. Now demand is growing extremely fast these days in memory, for the reasons that we discussed earlier. The fact that all the memory chips that you use in AI data centers is growing extremely, extremely fast, and so. As long as you remain rational in the way you add capacity, I think you could stop calling that a commodity. At the end of the day, if you have more demand than you can actually make, I think over the long run you could definitely justify not calling that a commodity anymore. But again, it's still a bit early to tell.
All right, Antoine, really appreciate you jumping on here. I know it's busy. And Antoine Chkaiban, equity research analyst of technology infrastructure at New Street Research. And just a reminder, Micron executives are scheduled to hold their conference call in about 1 hour's time, 5:30 p.m. Eastern time, 2:30 p.m. out there on the West Coast. When we come back after the break, we are going to check in on that breaking news involving Lithium Americas. We're also going to talk about that pending TikTok deal and sort of what it means for both China and the U.S. Stick with us. This is The Close on Bloomberg. All right, well, after a lot of back and forth, the U.S. and China appear to be nearing an agreement to sell the U.S. operations of TikTok to a consortium that includes Oracle. A White House official saying that Trump intends to sign an executive order this week to formalize his approval of the transaction. Jasmine Enberg joins us right now, Vice President and Principal Analyst over at EMarketer. And while there are obviously a lot of contours to this deal that we don't know about, one key detail that's come out is this idea that effectively it would be a new app altogether. Basically, if you have the old one, you have to get rid of it, you download the new one. Are people going to do that?
Well, it certainly poses a very big user migration issue for TikTok. I imagine that if people do have to download a new app, many of them will initially, if out of curiosity alone. Whether or not they stay and continue using the app to the same degree that they were previously, though, really depends on the user experience. I think there's going to be a lot of questions and concerns around whether this new version of TikTok is the same as the old TikTok in terms of content, users, and just the overall sort of experience on the app.
Well, that's what I'm curious about, Jasmine. I mean, it seems like, at least in the past, most of the reporting about the success of TikTok has been weighted towards the idea of what that algorithm is and how effective it is. That does not, at least based on the public reporting, appear to be transporting to the U.S. in this deal.
Yeah, well, overall, I think social media is just as much about the culture as it is the technology. So you can replicate the algorithm, but you can't replicate, the way that people are behaving on these platforms. I do think that some of the mystery around TikTok's algorithm has started to fade over time as competitors like Meta and YouTube have pretty successfully copied many of its characteristics. That said, of course, it's been a huge sticking point in these negotiations, and there's still a lot of questions over what it means when Oracle is the one managing the algorithm. And again, if that changes the kind of content that is recommended to users. I mean, one of the things we heard is that Oracle will retrain the algorithm on only US data, which is far less information than it would have if it had, data from users all over the world. And that, again, could potentially degrade the experience and affect how people are using the app.
Jasmine, we were talking a little bit earlier about Paramount Skydance, and obviously they have a close relationship with Oracle because, Larry and David are father and son there. Could you see a world in which they somehow get involved with this TikTok deal as well? Because Anna Berry, media analyst on my show yesterday, was saying she thinks, this could be the new distribution mechanism for traditional media.
Yeah, I mean, they would certainly benefit from getting their hands on TikTok's audience, right? I mean, TikTok says it has 170 million accounts here in the US, and we know that people are spending more of their time on social platforms. And so absolutely, I could see it being a potential business benefit for them and something that they might be interested in.
I was thinking about, Jimmy Kimmel's going to be back on the air tonight, except for Sinclair, which owns a lot of the ABC television stations, isn't going to put him on their terrestrial TV broadcast. I was thinking about how little that matters in this day and age, right? Because we all watch TV streaming, and a lot of Gen Z or even millennials are getting all of their media from a TikTok or from an Instagram or from a YouTube. Do you think that's going to continue to grow? Is terrestrial TV just dead at this point?
Well, I would say that consumer behavior is a lot more fluid than we like to think. People are using many different channels and many different devices, but it is true that social platforms, especially video platforms, really have become entertainment properties and are challenging many of the established TV distributors. And so according to EMarketer forecasts, we actually expect that this year, social video ad spending alone will surpass linear TV ad spending. And that is a clear reflection of the change in consumer behavior and advertisers really trying to catch up to where consumers are spending their time. I also imagine that a lot of people, to your point, will probably be watching, clips of Jimmy Kimmel on TikTok or even the full video later on YouTube, again, pointing to this idea that there's a very sort of fluid way of consuming media that also doesn't always happen at the exact same time of broadcast.
All right, Jasmine, great stuff. Jasmine Enberg is vice president and principal analyst over at EMarketer. And Matt, we should point out, we still have not really gotten final confirmation of any of these details. I mean, the Trump administration has alluded to the fact they're good on their end. We still need to hear from China on it. And of course, the contours of what this new app is really going to look like is going to be a big determinant of how much it gets used.
Yeah, absolutely. I'm so old that I have no interaction with TikTok. So I'm baffled by the whole thing and why why an American kid would want to use this Chinese data spy app on a regular basis.
I know.
I don't get it.
Yeah, we should be spying on ourselves.
Yeah, that's why I would use Instagram instead.
All right, we're going to talk about the world of venture capital with, well, a legendary venture capitalist. Tim Draper going to be joining us in just a bit when we come back right here on The Close, right here on Bloomberg. All right, let's take a look back at this day in history, because it was on this day 27 years ago when long-term capital management, one of the most lauded and opaque hedge funds ever created, was forced into a $3.5 billion bailout. A stunning fall from grace for the brainchild of former Salomon Brothers trader John Meriwether, who in 1994 recruited financial industry heavyweights like Goldman chairman John Corzine, New York Fed President William McDonough, future Nobel winners Myron Scholes and Robert Merton, and three of the brightest mathematical minds in the world, Victor Hagani, Lawrence Hillenbrand, and David Mullins. It was the Wall Street equivalent of an NBA all-star team. That brainpower was the secret sauce behind the fund's quant models that sought to exploit the presumed convergence in spreads between risk-free and risky assets. Buy the risky assets the model showed would appreciate, while simultaneously betting against the risk-free assets that were supposed to fall in value. That strategy, it was wildly successful. 21% annualized returns after fees in year one, 40% returns in year two and in year three. But it was in year four, 1998, where things went terribly wrong. The lingering effects of the 1997 Asian financial crisis had already made global investors skittish, testing long-term capital management's risk parameters. But it was Russia's debt default in August 1998 that sent investors on a mad dash for risk-free assets and a hasty retreat from everything else. In short, everything that long-term capital management owned, risky assets, was falling in price, and everything that it had sold short, sovereign risk-free debt, was going up in price. The counter moves, combined with the fund's outsized leverage, led to $4 billion in losses that brought it to the verge of collapse. It was only the mutual self-interest of the fund's lenders and a bit of nudging by the Federal Reserve that forced the heads of 14 Wall Street banks to ante up the money for a rescue, though the fund would eventually be liquidated a couple years later. The coordinated bailout has been widely derided for sending a signal that banks could take as much risk as they want, since the government would ride to their rescue to prevent widespread fallout. Too big to fail, if you will. A historical marker that likely paved the way for the U.S. bank bailouts that would come a decade later in 2008. Bailouts that fundamentally reshaped Wall Street, Main Street, and Washington alike in ways that we're still wrestling with today.
Wow. I have a new favorite segment on Bloomberg Television. That is fascinating stuff. Obviously, I lived through that, although I was still a kid in college at Antioch. But reading the papers every day, and I had forgotten how incredible the team was that they built up together.
Yeah, I mean, it was, and I have to tell you, I mean, I don't know if you have, there's a great podcast that just went into the history. It was like a 3-hour long, and it just really gets into just how opaque this firm was. But you talk about just the heavy hitters in there. It was like, you couldn't fail with these types of people. And I mean, there's a great book out there called When Genius Failed by Ron Lowenstein, who really kind of talked about, there was a little bit of certain hubris and ego that kind of got in the way. This idea that their models, if not infallible, certainly could withstand a shock. And what we found out is they couldn't.
And it did really pave the way for the bank bailout that came in the great financial crisis, and really, in a sense, for the SVB bailout that we saw as well. It would be interesting to see what would happen if regulators just let one of these big-name, high-profile failures flop.
And the great thing about Lowenstein's book, if you read it, there's been a lot of speculation that if they had just let them ride this out, they probably would have survived on their own. They would have taken some big losses, but it would not have been a systemic issue, which is what a lot of people have feared.
What a monumental on this day. Are they like that every day?
No, but thank you, man. I appreciate the compliment. I wish they all were. Let's take a quick look at what's happening in the markets. We did have a down day in the cash session. You're taking a look at the after-hours trade right now. You see Micron getting a modest bid, up at 1% on the back of its earnings, and more importantly, the guidance that it gave to seem to suggest there's still a lot of life in the AI trade. But let's go to the bottom of the screen there, Matt. This is a stock we don't talk about much. I don't think I've ever talked about it. Lithium Americas Corp. They've been trying to build out a lithium mining operation in Nevada. This company is actually based in Vancouver, Canada. But we just got some news from Reuters just a little while ago.
Yeah, that the U.S. is going to take a 10% stake in this company. And it's a tiny company, just to repeat that, right?
Yeah.
It had a market cap before the bell rang of $742 million. So it's almost nothing for the government to spend. But the interesting thing is what this portends. The U.S. doesn't want to be in a situation where China can push us around by withholding rare earths like lithium and the refined rare earths that are the magnets we need to do all of the high-tech, or what you might even consider low-tech things, like building a car. And so if we were able to do it here, we would be in a much better negotiating position. The question I have is, will we really be able to refine these rare earth minerals, because it's such a dirty and dangerous job?
Yeah, I think the last point is kind of what's held us back for those years, but maybe things are changing. Obviously, one of the biggest movers in the after-hour trade. We should also point out that Albemarle, the biggest lithium miner out there, which gets most of its lithium from overseas, up about 5% in the after-hours trade as well. We'll be back in a moment. This is Bloomberg.
All right.
Go ahead.
No, we're looking at some of the after-hours movers, and Micron, I think, is the most notable. As Romain pointed out, we've really been waiting for days to see this. A lot of hype coming into it, and really the analysts that I spoke to over the last couple of days were skeptical that Micron could meet and beat the high bar that had been set for it.
But it appears that they did. I mean, when you look at the numbers and the guidance going forward, it's well above analyst estimates, not only on the revenue side, but on the margins and, of course, on the bottom line as well. So maybe there was something to it, though we should point out the market reaction is still relatively muted. I mean, a 2% pop, although we should point out the stock has had a phenomenal run, up 40% just over the last few months.
All right, let's talk to a guy right now that knows a thing or two about chips, although far more interesting ones than this. Our next guest has funded numerous companies, including Tesla, Robinhood, and Coinbase. He's one of the largest individual holders of Bitcoin in the world, and he joins us now to talk about venture capital, his own flavor of it. Tim Draper is the founder and managing partner of Draper Associates. And Tim, I mentioned that you know a thing or two about the tech business because your family, I think, at one point emigrated from the East Coast to the West Coast to really be at the forefront of the chip and tech revolution. Tell us about your take on what's happening right now in terms of AI, because it looks like we're seeing another really seismic shift in technology.
Yeah, my grandfather was the first Silicon Valley venture capitalist. My dad was a pioneer in venture capital. AI is going to change all of our jobs. And if you use AI, you'll keep your job. If you don't use AI, you should. And I think this is one of those times where AI the internet changed everybody's job. The Bitcoin changed everybody's job in finance, and now AI is going to be changing everybody's job in numerous industries. We're really thinking this is going to be a real sea change, and it's very exciting. This is a really exciting time. The AI industry is in the hype mode, but what happens after the hype mode is it comes crashing down, but then it grows to be something bigger than anybody ever imagined. That's what happened with the internet. That's what happened with Bitcoin. That's what's going to happen with
Well, when we look at those,
AI.
when we look at those parallels, Tim, between the AI boom now and, of course, the internet boom of way back when, there's obviously a lot of talk of how you even figure out who the winners and losers are, because we now know in hindsight that a lot of the winners of that internet boom actually weren't even around during the internet boom. It's the alphabets of the world that really weren't part of that bubble, but sort of came about, or at least came public well after it. And I do wonder if most of the companies that could potentially benefit the most from what we're seeing today are still small, or maybe even don't even exist yet.
Yeah, I think that's the beauty of being in the venture capital business, is that we can make investments in companies where we're not exactly sure whether it's going to come together, but if it does, it'll be a great thing. And so I guess one way to play the AI world is to invest in a venture fund. But other ways, I think, would be that it is true that a lot of the big winners in the internet did not really exist when there was the internet boom and the bubble burst, but came back out of it. But there were some that were there, and they were not a big deal at the time, but then they sort of grew through it. And we saw things happen that we never imagined would happen with the internet. The idea that we would be able to use Uber or Airbnb, they were just very foreign to us at the time the internet was started, but they did come out. Google, I mean, they were worried about the Melissa virus. They were thinking, oh, I'm not going to touch that Google thing because it's got the Melissa virus. With Amazon, they said, oh, we're not going to put our credit card on the internet because I don't trust anybody on that internet thing. And then all those things changed. And so I expect we'll see similar things happen, and they're going to change. And I think we're going to see that happen in AI. We're going to see it happen in a lot of new industries that are popping up all over. We think the world's going from chemotherapy to biocures. And of course, Big Pharma is not going to be happy with that because cures. And I think we're seeing all of the companies that are now called dual use, but when we funded them, they were all called space or transportation or satellite companies. So the world does continue to change. This is a very dynamic world, and I think every time there's a new technology that sweeps through industries, it shakes us all up, but it also makes us so much better. AI is going to make us so productive, and so much economic value is going to come out of it. And I think people will find jobs. They will figure out new jobs with AI.
Tim, I want to ask about, when I was in college, I was using Netscape, and it wasn't until later that Google dominated. And at my first job, I was on Friendster and then MySpace. But of course, Facebook overtook all of those. And you can find countless examples of this. Wegovy was the pioneer in weight loss drugs, but now Lilly is killing it with Zepbound. How do you avoid those first mover losers and get to the ones that dominate, that really are victorious later on?
Well, some of it is, who's the leader of the business. And the best leaders in the world, of course, for governments, it's the same, are the ones that set clear guidelines and then trust people and set them free. And they do great things. Elon, he doesn't know how we're going to get to Mars, every piece of it, but he says we're going to Mars, and everybody kind of goes, that's crazy. Or they say, oh, I want to join him. How can I help? And then they get all involved in this new mission, this vision. So he sets clear guidelines, but then he counts on great engineers to solve each of those small problems in launching a rocket and getting people to Mars and getting them to live there, and terraforming Mars and all those other things. And then the weak leaders are the ones who try to control everybody and tell them all what to do. And that's like President Xi is, he's trying to tell everybody what to do, or President Putin.
Tim, do you find that these leaders maintain dominance? Because Elon Musk, while he did incredible things with a lot of companies, Tesla and SpaceX, just to name two, has he hit his peak at this point? I mean, is he still firing on all cylinders?
I hope not. That guy has done so much for us. He's extraordinary. He's making the world an easier place, and he's giving us a hedge in case we need to get to another planet. And then, of course, he's come up with all these other ideas: the brain-computer interface, the Boring Company, the changing Twitter to make it more free speech. I mean, I think the guy is really extraordinary, and we're just lucky to have him here on Earth.
Yeah.
And has he peaked? I don't know if a guy like that ever peaks. As long as he keeps working, humanity's going to be better off.
I do want to get your thoughts, Tim, here on what's been going on in the crypto sphere. Obviously, you made a huge mark in that space way back when. That looks very prescient now. You're still one of the biggest holders of Bitcoin, at least as an individual owner. I am curious as to just sort of what sort of fuels continued adoption, not just Bitcoin, but over crypto and other digital assets overall.
Well, I'm a big Bitcoin fan, and other crypto is getting to be a smaller and smaller portion of all crypto, whereas Bitcoin, the market share has gone from 40% to 50%, now 62% of all crypto is Bitcoin. And the engineers are well aware of that. And so when they innovate and they create something new on one platform, they port it to Bitcoin almost immediately now because they want that big user base. And the more users of Bitcoin, the better. And so Bitcoin has this network effect that continues to grow. And I think that is going to be really powerful in the days to come. And, where I used to sort of tell my friends, why don't you just put some portion of your money into Bitcoin, just some portion, some little portion. Now I'm saying, if you want to take care of your family, there's a non-zero chance that the dollar goes to zero eventually, and people are going to be clamoring at the bank to try to get their dollars out and to buy Bitcoin with them. And so now it's like, if you're a business, you really need to have at least 4 weeks of payroll in Bitcoin. And if you're a government, the governments are even buying Bitcoin in their treasury. And if you're an individual and you've got a family to support, make sure you've got like 6 months worth of Bitcoin, because if the dollar does go to zero, then you have no value on you. It happened with my dad gave me this $1 million bill once, and it was $1 million. And I said, whoa, $1 million, what can I do with it? $1 million bill? But it was Confederate dollars.
Oh, okay.
And I said, what can I do with it? And he said, nothing. And it was because the Confederates lost the war, and everybody wanted to get out of them. And so there was this inflation in Confederate money. And what it did was it pushed all of the value to the Union dollar. And similar things are happening with all fiat, because you've got a better currency out there. It's Bitcoin. And that's happening. And we better be aware that it could really change very quickly on us.
Hey, Tim, we're up against a commercial break. We have to leave it there, but we got to get you back. Particularly, we didn't even get a chance to talk about your pitch competition. I know you're bringing that to New York in a few days or so here. We'll catch up again soon, I'm sure.
Absolutely.
Tim Draper.
Meet the Drapers. Everybody should watch. It's great fun.
All right, and you can catch that right here on Bloomberg. Tim Draper over at Draper Associates. We'll be back in a moment. This is Bloomberg. All right, we want to turn back to Disney. The share is slightly lower on the day here, though we are learning that Jimmy Kimmel, the talk show host, will return to his late night show after being suspended over his remarks about the murder of Charlie Kirk. This is despite the fact that Nexstar and Sinclair, two of the largest owners of ABC TV affiliates, are saying they are not actually going to air it. Chris Palmeri joins us right now, who leads our media and entertainment coverage out of Los Angeles. And really, that's the big question here. I guess it's a bit of a triumph for Jimmy Kimmel, but if the affiliates aren't going to run this, Chris, who's going to see it?
Well, yeah, so Sinclair and Nexstar have ABC stations that account for about 23% of U.S. households. All eyes are going to be on Kimmel tonight, what exactly he says. Sinclair has called for him to apologize and donate money to the Kirk family. We'll see what tone he takes. And that may determine, how fast Sinclair and Nexstar put him back on the air.
It does seem, though, like something that everyone's going to see, no matter whether some linear television broadcasters decide not to put out the signal, you're still going to be able to stream it. And most people are, if they don't stay up and watch it at night, which is a pretty big ask these days, are probably going to rewatch at least clips on whatever, TikTok or Instagram, or even the whole thing on YouTube tomorrow, right?
Right. I mean, that's exactly why late night TV is in the problem having the problems that it is that, people aren't watching traditional television like they used to. And so people are just going to watch highlights, whether they be on YouTube or TikTok or any place else.
It raises the question, though, Chris, about just really sort of what this whole exercise is about. I mean, I think last time we talked, we mentioned that Jimmy Kimmel's contract was already scheduled to be up at the end of this year. So bringing him back here in late September for, I don't know what you call it, an apology tour or a victory lap or what. I mean, what is the end for Disney at this point?
Well, for Kimmel, he wants to leave on his terms. He doesn't want to look like he got kicked out. And by the way, I think it's the end of the season, TV season, which is usually in May. So this kind of TV year when his contract's up. And, for Disney, they wanted to keep him for a little while longer, for sure. That was the message we were getting. There is a certain cachet to having a late night show. And, we've talked about being able to promote your programs and your movie stars and that. And especially for Disney on this theater that they have right on Hollywood Boulevard that's been the home to the Kimmel studio.
All right, Chris Palmeri, our man out there in Los Angeles. And of course, all eyes right now are on that studio out there where they are going to begin taping Jimmy Kimmel Live, which I've learned is not actually live. So they will have a chance to make sure they vet anything.
Hang on, it's called Jimmy Kimmel Live and it's not live?
Yeah, apparently it tapes at around like 4 p.m. West Coast time or so. Normally, I assume that's the same case for today. So, and I would assume, particularly for this comeback
that's
today,
misinformation.
They would love to make sure that this is actually taped live.
I think Brendan Carr needs to look into that. Yeah. They say it's live and it's not.
Yeah, absolutely. Here, I think he's got enough to look into. Let's look into what could potentially move the market over the next 24 hours. We get some earnings, Matt. I don't know if you care. Cintas, Uniforms, KB Homes.
Yeah, absolutely. I think the housing market is one that we're all watching very closely. The president, the Federal Reserve, and Bloomberg as well. So it'll be interesting to see what they have. We also get MBA mortgage applications. That plays into that. New home sales. That plays into that. Building permits. That plays into that. So a lot of housing data coming out.
The Fed speak continues, including from San Francisco Fed President Mary Daly. There's a lot of people now trying to parse the yin and the yang between all of these Fed members who seem to be on different pages about rate cuts.
And then tomorrow, UNGA continues. So try and take public transportation if you're commuting in Manhattan.
All right, we'll have full coverage of everything that comes out of those proceedings right here on Bloomberg.